welcome to another episode of Inside Mortgages. Today I'm here with Mark Edwards, the founder and principal of Mortgages and Insurance Solutions, Steve Guttridge, one of our senior brokers, and myself, of course. Today we're here to talk mortgages. Hi guys, how are you feeling today?
Hi Salome, I'm feeling really well, thank you. I'm looking forward to talking about some really interesting topics that I think are going to be really useful for people out there that are looking to get involved in mortgages.
Yeah, nice to see you guys. Had some really good feedback from the last couple of episodes that we did, right? We had some really interesting questions, and I guess the topics today, we're going to go into a little bit more detail and answer some of them questions. So yeah, exciting. I'm really looking forward to getting into the conversation and see where it takes us. What have we got on the list today?
Okay, so before you guys start talking, I want to ask a question. I've seen on our newsletter something to do with a mortgage that requires no deposit. Now, is that true? How does that work? Can you explain?
Yeah, well, I can tell you a bit more about that, Salome. It's not too good to be true. It is a 100% mortgage. Now, it's a new product that's just come on the market, launched by a lender. It's actually for renters. Now, the idea behind it is, if it's called track record, and the case is, if you can afford to rent, you can afford to buy, for most people. And the rationale is, if you can show at least 12 months rent payments made on time out of the last 18 months, then the lender is prepared to give you a 100% mortgage. There's a few details, it's always in the detail, yeah, there's that and the criteria that you need to meet. Yeah. The first being, the maximum term is 40 years. Yeah, so for affordability, which is quite good, so you can extend the term to reduce the monthly payment and make the mortgage more affordable. The other thing is that the mortgage payments can't be more than 20% more than your rental payment. So that in terms of pounds and pence, if you're paying rent of say 1,500 a month, it suggests that you can afford a mortgage payment of up to £1,800 a month. The other thing is to remember is the maximum income multiple. So whereas with most mortgages you can borrow up to 5 times, you can actually do this also on the track record mortgage. So for a new renter, as long as your income is at least 5 times, you can borrow up to 5 times income, which is a really good thing.
Yeah. Okay. What about if you've owned a property in that time, in those 3 years or before? It's
only for first time buyers. So you can't have owned a property in the last 3 years.
Okay. And is it on is it a sole purchase, or it can join? Can you do it?
Same as the income multiples, that's the other good thing as well. It's up to 5 times income, either sole or joint.
Okay.
So as long as both borrowers have never owned a property in the last 3 years, that you're going to qualify. So I think it's going to be a big deal for people who are renting, for looking to get on the property ladder, because for many people who are renting, the problem is they can afford a rent, but they don't have a deposit to actually purchase a property. Now, the key thing here is, if you look at actually saving for a deposit, I think Nationwide done a survey recently, done some research, and what they found was that the average deposit is $23,000 for first-time buyers, and it's taken them at least 6 years to actually save that money.
Oh, okay.
With a situation like this, and in 6 years, if you're paying $1,500 a rent per month, over 6 years, that's going to be $108,000 that you would have paid in rental money and have nothing to show for it in that time. This gives you the opportunity, if you can afford it, to be able to get on the property ladder now. Instead of paying rent, you can buy a property, usually for the similar property the one that you're renting, actually own the property and be the first step to home ownership. So it's a big change in the market.
I think it's great, really, because I think you know this as well, Mark. Over the years of talking to people, you always get going, look, I can afford my rent, but I'm just not in a position to get myself a mortgage. There's so many people like that.
Absolutely.
And as you say, they can afford their rent because they're living, they're
Absolutely.
paying their rent, they haven't missed any payments, but they've got that in the back of their mind that they're not in a situation to. And I think it's great that lenders now are kind of addressing that. And this has come to market to help more people get on the property ladder, right?
Yeah. It's a real world solution.
Yeah.
Do you guys think it will help younger people get a mortgage now?
Yeah, I believe so, because I think, if you look at, say, young professionals leaving university, getting their first job, getting established in their career, probably in their mid to late 20s on a decent salary, most of these people are renting. Yeah, this gives them the opportunity, as we said, because it's going to take them probably 6 years on average to save a deposit. It gives them the opportunity to actually get on that ladder now, rather than waiting 6 years and having 6 years of rental where, it's dead money. So hopefully we're going to see more people taking advantage of this.
And what was so they do have to still start renting though, right? So if you've come out of
Yeah,
uni,
it's called track record.
Yeah.
So you have to have a record of paying your rent on time for at least 12 months at the last 18, as I say. And the reason for that is it's because that shows that you're responsible, you're able to manage your finances. Yeah. So it's another way of the lender to assess risk, and they know that you're likely to be to pay your mortgage on time and be responsible with the commitments.
So you're saying that's just a year, is it?
Yeah, 12 months out of the last 18.
Okay. Will it work for someone who has bad credit though?
They need to have a decent credit record. I think we're going to talk about bad credit now. Actually, maybe that's an area that we could actually talk about now. Applying for mortgages when you have bad credit. I think it's got better for people. A lot of people think when they have bad credit that they're going to be automatically declined. Yeah. That is not necessarily the case. And also people think if they've got a low credit score, they're going to have difficulties getting a mortgage. Now it is a challenge, but what you need to understand is you need to get a good look at your credit report and actually get a broker, someone that understands credit reports and that can actually help you to find the best solution for your situation. Yeah.
So what is the difference between credit history and a credit score, for example?
Okay, so credit history is basically a record of all your dealings with banks, accounts, and financial institutions. So if you borrow money or open a bank account or have a credit card, it's going to show all your history or whether you've paid your payments on time, or if they're late, how late, or if you've missed any payments. It'll also show public record information such as county court judgments, CCJs, defaults, and bankruptcy. These factors will affect your score, your credit score. Now, your credit score is different from your credit history. Your credit score is going to be a 3-digit number, usually between 300 and 1,000. Obviously, the higher the number, the greater your score. Yeah. The thing about your credit score, it's a way for any prospective lender or financial institution of getting a quick overview of your credit worthiness. So when they look at your score, it tells them quite quickly how likely are you to repay any borrowing that you take out. The score is only half the story, though, and although it may give them an initial overview, the history is just as important. Now, the history is going, as I said, is going to show the conduct of each account and whether or not you have any county court judgments or defaults, or if you've ever been made bankrupt or had an IVA. Now, all of these factors will lower your score if you've missed these payments, or if there's any negative information on your credit history. So that's the main difference between credit history and credit score. The credit history is you will get from one of the three main credit agencies in the UK, Equifax, Experian, and TransUnion. They will provide your credit report. They also will give you a credit score. However, they don't calculate your credit score. There's 2 companies that do credit scoring, and it's a complex formula. And they take the information from your credit history to arrive at your credit score. It's a complex formula which changes constantly. The other important thing is to realize is that although your credit history goes back 6 years, and that information will be on your credit report for all your accounts information will be on your credit history for 6 years, your credit score continually changes. So your credit score will change each month, and it will go up and down depending on the conduct of your accounts. So you can actually have a high credit score and poor credit history. You see, so that's why sometimes we've had it where a client's been declined, and they'll turn around and say, "Well, why I've got a 999 credit score? Why have I been declined?" It's going to be because of the credit history. Okay, so this is another reason why you use a broker who knows the criteria of different lenders and what they're looking at, because you have some lenders who don't credit score. The majority of lenders that do credit score. However, you then have to look at how their criteria judges history. So things like, as I say, like the CCJs, the defaults, the missed payments. Also, it's what have the missed payments been on? Because lenders will put different gravity and weight to different types of missed payments. Things like utilities and mobile phones is seen as less serious. The worst account to miss a payment on will be a secured loan, i.e. a mortgage or a secured loan, second charge loan. Yeah, those are the ones that you don't want to miss because lenders see that as really, really serious, and it will definitely lower your credit score.
Yeah, sounds.
Have any of you had any recent cases?
Do you know what? Recently, yeah, I had, and what Mark's saying is really interesting because actually, monthly it does affect it. I got a decision in principle through for a couple, and they're buying a house. They're house moving. They're both on. Actually, he's the main income person, so he was on roughly about 120,000 a year, and she just topped it up with like 20. So we put in a joint application and got the decision in principle put through, and it was all successful. Obviously, the time between that and them going to actually get the application put through was a couple of months, and they rechecked their credit, and it came up that British Gas, it was like £6, right? It was £6, and it was a default, and actually it was British Gas had not done their due diligence properly, but it was on the account. They got it removed, but at the time it didn't matter. So the importance of kind of keeping on top of that is really, really high. And what we had to do, thankfully, we got it through. We had to change the application into his name, his sole name, and it got pushed through because his affordability worked out, which was great. And obviously, you don't want to go back to a client suddenly and say that you can't have your house now. You know, it's a massive effect, isn't it? You know, people are moving house, it's their dream home, it's their next stage in life. And, you know, these small things. And I think what would be really interesting, Mark, is like, you know, you're really experienced in what can go well and what can go wrong. And as you say, as brokers, when people say, you know, why do we need to speak to you? When, you know, there's never a real right time, but if you can plan ahead, we can say to you, like, keep an eye on your credit history and your credit report. Don't go out there and take out unnecessary loans and stuff, because this is the main thing that you're trying to do, right?
Yeah, people don't realise how, like you say about taking out new credit. If you're thinking about applying for a mortgage in the near future, one of the things that you have to be aware of is taking out unnecessary credit can affect your affordability, can affect your credit score. Things like mobile phones, upgrading your mobile. It might be great to get the latest iPhone, but you've got to realise that if you're doing it on a contract, it's a loan. This is another commitment. So not only can taking out a number of new accounts in a short space of time can reduce your score, but also your commitments are going up. Because when we do an affordability test, we've mentioned many times about income multiples, but we also have to do a more detailed affordability calculation, and all your commitments, i.e. all your monthly payments, can affect, depending on your income, can affect how much you can borrow.
Even like ClearPay, Klarna.
Klarna's another one, you know, that's become really popular in recent times, you know, especially with the younger generation. There's, you know, any new purchase, it always pops up on your phone. This is available to be purchased via Klarna.
Yeah.
Sounds great, spread the payments over time, but it's another commitment. So again, it can reduce how much you can borrow. Again, it's another credit agreement taken out in that period. Yeah, so it's something to keep an eye on. So one of the things that I had recently was a client who, you know, we were looking to get her agreed for a mortgage. We've done the affordability, and we found it all seemed to work. We've applied for the mortgage, and the amount that we was hoping to achieve, the lender agreed the client, but not the mortgage amount. They gave us a much lower amount. So we've looked at it into more detail. Because we've asked her at the start what commitments she had, and she didn't have much in the way of loans. But it turned out she had 4 daughters, and she had taken out mobile phones for each one of them. So she's paid, so she's helping her children. She's given them each mobile phone. She's done the contract in her name. They pay for the mobile, but she's taken out the contract in her name. Yeah. But all these are commitments. So these £50, £450 a month turns out to £200. Now that has a big effect on the maximum amount she can borrow. Yeah. So, people have to look at that, so sometimes if, I understand why people would want to help their kids get a mobile phone, but, or maybe even a car loan, something like that's another one, where people are helping their children or maybe a family member. But the thing is, when you're now looking to apply for something, it will make sense to actually try and get that credit into their name rather than yours, and so as it doesn't affect, your own financial situation and what can be done.
Well, that would also help them in the long run, the kids,
Absolutely.
right? Start getting on the old ladder to build their own credit. So,
builds up their own credit score and credit history.
Because it comes back to that tracker product where people need to have some kind of credit history, right?
Absolutely.
To take advantage of that.
Absolutely.
I think slowly.
I think another way to actually improve your score is to, one, ensure you're on the electoral roll. A lot of people, some people think, because they're not interested in politics, not interested in voting, don't get on the electoral roll. But that's one of the things that will greatly improve your score, is being on the electoral roll. So that's, if you're looking to apply for credit, apply for a mortgage, really important, get on the electoral roll. It will raise your score. The other thing is having accounts over a period of time. So if you've not taken out credit or you don't have a credit card, one of the things to do is Experian, do a thing called Experian Boost, where accounts that are not necessarily showing on your credit report, maybe a mobile phone or a utility, things like your broadband, that you may have had for a number of years, you can get that registered with the credit agency, and that automatically improves your score, because it's an account that you've had for a number of years and you've been making monthly payments. At the end of the day, if you think about it, all lenders are trying to do is see how likely are you, if they give you this loan, how likely are you to make your payments on time every time? And no one wants to be the first person to lend money to you, or appear to be the first person to lend money to you. That's why your score will be low. People think, I haven't got any credit, I haven't got any credit cards, I haven't got any loans. Isn't that fantastic? Not necessarily. Yeah, it makes sense sometimes to just have a credit card and clear it monthly, because again, what you're doing is building up your track record.
Exactly.
That's why they call it the track record mortgage.
When we talk about it and it kind of makes sense, right? Then, as you say, but I guess it's one of the reasons we're doing this, is to kind of get the information out there to all the people that are just curious about how to do it. When it comes to credit reports and stuff, when you're talking about first-time buyers, because I know you've mentioned before, like, you don't have to get a residential mortgage, right? You could get a buy-to-let that you could kind of start on the property ladder. Is it the same with a credit report in that, or are they a little bit more lenient? Because,
what, for buy-to-lets?
Yeah. Because it's not relying on your income, is it? It's relying on the rental income rather than you as a person.
Yeah, I mean, in the buy-to-let world, the lenders, as regards income, there are majority of lenders, buy-to-let lenders, will have a minimum income. Right. So they're just looking to see that you're able to manage your finances and live day to day, but not be reliant on the rent.
Right.
Yeah. But that minimum income is usually something in the region of 20,000. So that's pretty good. But we've also got lenders with no minimum income. So we've got maybe 2 or 3 lenders that will lend on a buy-to-let basis, even if someone's unemployed, but they're able to support themselves. That's fine. Yeah. From a credit point of view, we've got buy-to-let lenders who will lend in what we call the adverse credit situation, because it's not reliant on the personal income. The property kind of stands alone. The mortgage is going to be paid from the rent.
Right.
Yeah. So that in some cases we can do that. We can get a buy-to-let mortgage for somebody who has poor credit, hasn't got an income, but they've got a decent profile other than that.
So I know we're talking about kind of entry into the mortgage products and trying to get people onto the property ladder, which is great now, as you say. That the whole way people are going, this rental thing is amazing, and I think a lot of people will jump on that, especially in the next couple of years once they know about it and know how to do it. And I think it's great to see that the industry is moving towards helping people like that. If we're looking at the other end of the spectrum, Mark, like large loans, I know you've got some information on that. Please tell me about some of the stuff that you've come across for people that want to take out large loans for like multi-million pound properties. And
yeah, that's interesting. We've had something recently come about. We had a new lender launch a product to help the large loan sector, and the big thing there is that so far we've mentioned income multiples a few times now, but the maximum multiple is across the board really is around about 5 times income. Lately, you've had a few 6 times income lenders come on board, but not many. It's very niche, very small. But there's always a cap on multiples. But what happened is a lender contacted me and told me about a new product they had. It's aimed at high net worth individuals who may not necessarily show on paper that their income is of the level required to take out a multi-million pound loan. However, they have an income of at least 150,000. Now, the great thing about this product is if the client has a profile where they can show that they have the assets, they have the business background that's showing an income of at least 150,000, and they're looking to purchase a property of at least £1 million, and they're looking to borrow anything from 1 million to 5 million, there is actually going to be no income multiple cap. Right. So it's a big thing, and it's a big deal. I heard about that from the lender and immediately saw the potential. So we did a newsletter out to our database, sent that out, and within an hour got a phone call from a client who was based in Surrey. He was looking to do a £3 million purchase, was looking for a loan of 2.4 million. He was a IT consultant, but also had a management consultancy business. He can show the 150, no problem, but was, as you can imagine, to borrow 2.4 million, that's about 8 times income. Up until this point, nobody would do that. However, with his background and his profile, he had, as the consultancy business, had good profits in the past and was trading well. But himself and his wife, they weren't drawing any income from the consultancy business. But he could show the 150, was able to package that case up, put it to the lender. Was a blip along the way because he did have some adverse credit. He'd missed a couple of payments on his American Express card, but that was down to just being disorganized. Not setting up a direct debit. Payments were late. It wasn't that he was short of funds. It was just mismanagement. Explained this to the lender, present the case in the best light. The underwriter, it's bespoke underwriting, so the underwriter understood the situation, could see the quality of the client, and we were fortunate enough to get a mortgage offer out within 3 or 4 weeks. The client was over the moon, and exchanged contracts 3 weeks after receiving the mortgage offer. So that's a great success story.
Yeah. And I hear you're the first person to get over the line.
Yeah,
Mark.
Yeah, that was the thing. It was, quite a lot came from that.
Yeah.
We were actually the first firm to actually get a successful case on and the mortgage offer out on this new product. Yeah, it's a premier product from the lender, small niche building society. But that's the thing about having a good broker, being on top of the market and knowing what, as new things come online, what the benefits are for the client.
Yeah.
Yeah.
Well, I think that's what us as a collective, as a team, do really, really well. Is like keeping on top of the market, keeping on top of criteria. Because as we all know, it changes every day, every week.
Absolutely.
And obviously with the information that's out there, everybody gets information, throws it at us. We can get this, we can get that. But again, it's like ciphering through all of that and making sure you come out with an achievable product that actually works for people, rather than just all this white noise that's going around. And
Yeah.
I think the weekly newsletters, what you're saying, they're really kind of aimed at the market and the current market and how it's helping and the best way to move forward. Hence why, these discussions are really important. And,
Yeah.
and for the current climate,
Absolutely.
especially.
Absolutely. I think, the newsletter, I think, is important. The whole point of the newsletter is to actually communicate to our database and let people know what new initiatives are out there, because what can be done today or can't be done today is not necessarily the same tomorrow. Yeah. So I always say, you never know it all, and you never will know it all. It's not important to know it all, but it's important to know how to find out. So for people who are not subscribing to our newsletter, I strongly advise them to subscribe. Because it really, we only communicate interesting information that could make a difference to our database and to our clients. Yeah.
That's right.
Things are changing all the time. New initiatives, new products.
Talking of that, what do you feel that's come onto the market recently that's kind of in the forefront of your mind, that's really kind of making a difference? Any other products or any other?
Yeah, I think there's been the income multiples. We had another lender this week increase their multiples to 7 times income. Yeah, again, it's what we call a specialist lender. It's funny. What's a specialist lender? A specialist lender is a lender who's basically solving a problem. It's a solution. They're the standard lenders, the high street lenders, if you like, appeal to the mass the mass market. They're looking for the premium business. They're risk averse. But which creates the opportunity for the specialist lender, because not everybody is going to fit that model, or into that space. So it's quite interesting that we've had this lender. It's not a new lender. They've been around a long time, but they've now recently gone up to 7 times income. It's always in the detail. There are caveats to that. Your income has to be at least 75,000. So they're looking for the high earners, but it's a big deal. It can be a game changer for a lot of people. I think the other big thing that's come out recently, a new product, is the deposit. We've minimum deposit in most cases is 5%. Okay. However, just this week, a lender has brought out a 3% deposit product. Now, that's a big deal, and I think we're gonna talk about that a lot more in the next episode. Because I know we're running short of time, but that's another big deal, Steve. As I said to you before, what's possible today is not necessarily the same as tomorrow. Things are changing all the time. This market is quite fluid.
Yeah. And I think one of the key things is, as well, I'll bring it back to the business, is we're actually forward thinking. We're thinking, what's the problems that people are going to be facing and what are the solutions? And then we put them out there. Because as you say, it's like all information, right? Until it affects you, until it is directed at your circumstances, you probably don't take notice of it. But again, that's why each week check in with what we're sending out, the information we're sending out, because one of them may be subject to what you need. And you go, oh yeah, or you know somebody, or as you're saying, and it doesn't cost anything to ask or get in touch with us or email or just phone through, because we're all great people here, right? And we're trying to do good jobs, and we're happy to help. So, that's what we're in this business for, right?
Yeah. I think it's really important that, speak to a broker early. If you're interested in taking out a mortgage and you don't know what's possible, how much you can borrow, or how your credit history may affect your chances, speak to a broker early. You know, we're experts. We're in this business every day. We're aware of what's happening. So best people to speak to actually give you some answers,
Get ahead
take
of the
you
game,
forward.
right? Yeah, get ahead.
That's
Knowledge
it.
is power,
Absolutely,
as they
absolutely,
say. But
Steve.
yeah, cool. Well, thanks, Mark. Really appreciate that.
Thank
And
you,
Salome.
guys. Thank you.
Cheers.